నమస్కారం. డాక్టర్ బిఆర్ అంబేద్కర్ సార్వత్రిక విశ్వవిద్యాలయం విద్యార్థులకు స్వాగతం. ఈ ప్రసారంలో
Hello students, today as a part of management control systems we are going to discuss on evaluating the performance of investment centers. Investment centers part of responsibility centers. The concept of responsibility center is taken from responsibility accounting. Why should we go for responsibility centers? The answer to this question is very simple. In today's business world, with increasing number of large, complex, multi-product and multinational organizations, it is very difficult to manage the business by sitting at one place and confining the operations to one geographical region. The most effective method of designing the control structure in such organization is adopting responsibility accounting. Responsibility accounting is a type of accounting of management that collects, reports the planned and actual information in terms of the responsibility centers. What is a responsibility center? There are at least two criteria for recognizing an organizational unit as a responsibility center. Number one, it should be separable and independent for operating purposes with specific work or process. Often referred this process as goals, input and output. It should be headed by a responsible manager and is accountable for the results with effective delegation of authority. The types of responsibility centers are three: cost center, profit center and investment center. Cost center, accounting only for costs sometimes becomes inevitable because of the difficulty in measuring the output. So when the performance is measured in terms of the cost incurred, it is called as cost center. Where you can measure both costs and revenue, it is called as profit center. So profit center performance is measured in terms of the profit. The third part is investment center. Here manager is responsible for costs, revenues as well as investment in assets. It is an extension to the profit center concept. The essence of investment center is the relationship between profits and the assets used to generate such profits. In many organizations, you have the product groups which are often designated as strategic business units. Similarly, many companies will have branches operating in different places. So these branches or these strategic business units can be conveniently termed as investment centers. Then why should we evaluate the performance of investment center? So this is a big question because after all company is one. But if the company wants to concentrate on the investment center which make profit, you have to measure the performance of investment center. Many firms use profit centers to evaluate managers, but firms cannot use profit alone to compare or to evaluate the business unit, because the differences in the sizes, differences in the operating characteristics makes it difficult to go with the profits. You have to take the concept of investment centers. By evaluating the performance of investment centers, management can concentrate on that strategic business unit which gives better return. Investment decisions can be more rational, more pragmatic also if you continuously evaluate the performance of the investment centers. Apart from this, the other objectives of evaluating investment centers performance include: number one, motivating the managers so that managers can exert high level of effort to achieve the goals of the firm; to provide the right incentive for the managers to make decisions that are consistent with the goals of the top management, which indirectly leads to the goal congruence. Then fairly, it determines the rewards earned by the managers for their effort and skill. ROI is a sound basis for comparison between two strategic business units or two departments. Now, how to evaluate? There are three approaches for evaluating the performance of investment centers. Number 1, return on investment. Number 2, residual income. Number 3, economic value added. We have other methods also which will come at the end. First, we will talk about the return on investment. Return on investment is a very common measure of performance for an investment center because it relates to the operating profits to the assets employed. Decisions taken based on the net income without considering the investment made by the firm gives misleading results. ROI can be computed as operating income as a percentage over average investment. Alternatively, ROI can be calculated by using the DuPont approach, that is ROI is equal to profit margin multiplied with investment turnover. That is, the product of profit margin and investment turnover will give you a ROI. The two components of ROI which give rise to the return on sales and the assets turnover give wide clues for the management. Return on sales or the profit margin. A firm's profit per sales or a dollar measures the manager's ability to control the expenses and increase the revenue to improve profitability. Similarly, assets turnover, number of times sales for a given investment, measures the productivity and reflects the manager's ability to increase the sales from a given level of management. What are the advantages of ROI? ROI is a commonly understood measure. It can be compared with the interest rates or the rate of return of other investment centers, and it is widely used and reported in the press. There are certain limitations for the ROI as well. The goal congruency issue, incentives for higher ROI units to invest in these projects with higher ROI may sometimes discourage those projects which are beneficial from the point of the corporate profitability. Comparability across the investment centers merely based on ROI is also not justified in long run. Then which ROI we should take, or how to evaluate the performance with ROI? There are three types of analysis with ROI. ROI can be taken with trend analysis. ROI can be compared with other strategic business units. ROI can be measured with the risk-free interest rate. When you go with the trend analysis, just by comparing the previous year ROI, you can judge whether the investment performance they improved or not. Similarly, when you compare the ROI of this investment center with other investment centers, that investment center relatively with higher ROI definitely gives better incentive and better recognition. Apart from this, ROI is often compared with the risk-free interest rate to justify the investment. The second important measure to performance investment center is the residual income. In contrast to ROI, which is a percentage of the income over the investment, the relative performance of the investment center can be measured with the help of residual income. What is residual income? Residual income is the investment center's income less imputed charge for investment, that is, less the capital charge. Residual income can be interpreted as excess of operating income over and above the minimum required earnings calculated based on cost of capital. So when we talk about the minimum required rate of return on assets base, similarly when we talk about the asset base for the investment center based on ROI also, how to take this investment base? There are two commonly approaches for investment base. One is total assets, the other one is total assets minus current liabilities. Cash dividends, branches keep similar amount of or smaller amount of cash which may not be included in the assets of the investment center, and that is a big problem in calculating the asset base for the purpose of residual income as well as for ROI. Similarly, the asset accounts which are maintained with the corporate office or head office may not be reflected in the accounting entity of the investment center. When you go with inventory valuation also, which is part of the assets, the stock based on LIFO is not properly valued. Similarly, the plant and equipment may be undervalued or overvalued based upon the method of depreciation. The new assets acquired and the common facilities used by this investment center are not included in the part of the asset base. However, the problems with ROI can be avoided by taking a little precaution. Now let us take a small case of ROI, how it can lead to misleading results, and then we will see how to remove these misleading results. Now see from this particular slide, though there is no change in the net operating income, your ROI constantly increased from 30% to nearly 150%. So this is a misleading result because of the change in the net asset value resulting from the diminishing value of the assets. So with simple decline in the value of assets, although there is no increase in the net operating profit, your investment center is likely to report a higher profit than what it has earned. This can be removed, or this problem can be overcome when you take the asset base as a common value based upon the historical cost or based upon a straight line method of depreciation. Similarly, in case of residual income, the investment should be reduced with the minimum required rate of return, and that will reflect ultimately what is the residual income after the minimum required rate of return. You see from this slide, the investment is 5 lakhs, the minimum required rate of return is 12%. So the minimum income required is coming to 60,000. If you deduct this 60,000 from an actual hypothetical income of 1 lakh, the residual income is 40,000. So higher the residual income, higher will be the contribution of this investment center from the point of the overall profitability. The third important measure of performance evaluation of the investment center is the economic value added. Sometimes ROI may result in discouraging the investments, as I told, that are desirable from the point of the view of the overall profitability, although they give a lower ROI from the division point of view. To compensate this tendency, EVA can be adopted. If EVA is a positive to investment center, it can contribute to the corporate profits. How to calculate EVA? EVA is after tax operating income minus the weighted average cost of capital multiplied with the capital employed, that is the capital charge deducted from the operating income. Accounting issues involved in computing the cost of capital are to be taken care of. Which cost of capital? Usually the weighted average cost of capital based upon the proportion of debt and equity can be taken for calculating this weighted average cost of capital. Similarly, the capital employed is the net asset block plus net working capital is used in case of the assets employed. But however, care should be taken in taking the depreciation, R&D expenses, and similarly the other important parameters. So these three important items, the measures, are taken for calculating the value of the performance of the investment centers. But apart from these three methods, there are other methods for calculating the performance of investment centers. One important method is the balance scorecard. Balance scorecard is understanding the performance of investment center from the 4 dimensions. The 4 important dimensions are financial perspective, customer's perspective, technology and growth, and internal process. The first one is financial perspective. Is the firm able to achieve the financial goals from the point of the wealth maximization and profitability? Second one is the investment center able to support or simplify the critical internal processes? The third one is, are we able to meet the customer's expectations? Then is the firm is able to maintain and sustain the growth with technology, with innovations, and implementing the innovations? Probably an objective method on these 4 balanced scorecard may not be possible unless you add quantitative measures to all these 4 important factors. For example, the financial perspective can be made more rational when you add the return on capital employed, similarly the return on net worth, or the return on the equity. The customer's perspective can be visualized from the point of the customer complaints and the quality control measures and the number of rectifications. These things will help in assessing our performance, whether we are able to meet the customer's expectations or not. Similarly, the number of new products implemented, the product modifications and increase in the product designs may be used to measure the performance of technology and growth. Then ultimately, how you are able to support the critical processes with your investment centers. Every business will be investing in every operations or in every activity, and every activity will translate one day or other in terms of investment center, as they also consume the assets or the other infrastructure of the business. Now, whether they are supporting with the basic objectives of the business or not, that is an important aspect to be taken in the internal process. The other process or the other measures for evaluating the performance of investment centers can be used more judiciously when you take care of these issues into account. Number one is the goal congruence. Managers should select the actions which maximize the overall profitability rather than the divisional profit. Any conflict or any dichotomy between the divisional goals with the corporate goals should be minimized and should be sacrificed for the point of the overall profitability. Similarly, the performance evaluation responsibility center involves measurement of input and output. There are accounting, administrative problems in measuring the joint costs and joint revenues. After all, the joint costs and joint revenues cannot be separated for an investment center on an arbitrary basis. Then the biggest problem is, as investment center is an extension to the profit center, we have the same problem of transfer pricing. When one investment center sells part of its product or service to other responsibility centers in the organization, how to price these products or services? There are several other methods for pricing these internal consumers. Maybe the marginal cost, maybe the total cost, maybe sometimes the market cost, maybe the replacement cost. Any method used as a part of transfer pricing should be justifiable, should be used systematically, consistently, so that the profit of the investment center is not adversely affected. Another important issue in measuring the performance of investment center is controllable versus uncontrollable cost. When you are taking the costs into account, after all the costs are not controlled by the investment center. Especially when we talk about the apportioned costs, they are the costs attributed to the investment center on some basis. They are uncontrollable costs. So we can control the uncontrollable costs, but not the uncontrollable costs charged by the corporate office or the head office. Then constants from the other responsibility centers which will affect the profitability of this investment center. So another biggest problem in measuring the performance of any responsibility center is the performance is a collective effort, and performance is not the effort of any individual responsibility center. Now, how to take care of or how to reduce the impact of the performance of other responsibility centers in measuring one responsibility centers? Apart from this, the issue is between always the autonomy versus accountability. Every responsibility center is defined as an independent unit of organization with some delegated powers. But there should be an intelligent trade-off or a cutoff between the autonomy and accountability. How much powers can be divested and how much accountability you can expect from the responsibility center over a period of time. These issues can be solved by taking into account the structure of the organization and also the reporting system over the long run. Apart from these measures, in measuring the performance of investment center, we have the other ratios which are supporting in the measuring the performance of the assets employed investment centers. We talk about the inventories. The performance of inventory can be measured just by taking our old inventory turnover ratio. Inventory turnover ratio is nothing but the cost of goods sold to average inventory. Similarly, you can also measure the productivity of the debtors by calculating debtors turnover in the investment turnover. The investment performance center can be measured by taking the debtors productivity or with the help of the average collection period. Average collection period refers to the number of days sales that are tied up in the form of book debts. These two important ratios can be used along with your working capital turnover. Working capital turnover, again, sales by working capital. Usually working capital we take the gross current assets or you can take the net current assets, but you take whether the total current assets or net working capital, but it should be used constantly to measure the performance of investment center. Similarly, the productivity of the fixed assets can be measured by taking each asset with the relative productivity measure. For example, the output input ratio in the plant, or the output per machine hour, or the output per man hour. So these productivity ratios can be also used in the investment center. But the performance of investment center should be taken almost similar with the measurement of divisional performance, because in measuring the divisional performance you are taking the divisional assets and the divisional costs, the divisional revenues. Here also we are going with the same concept of divisional assets, divisional costs and divisional revenue. But sometimes when you talk about the division is confined to the product group, but investment center can be only with an asset. The entity is asset and accounting entity. So here what is the testimonial is, there should be a group of assets used for that purpose, and there should be also an accounting system prevailing at that investment center, so that the costs can be segregated and revenue can be also used for determining the performance of that investment center. Apart from this, in measuring the investment performance, another important problem in measuring the performance of investment center is the employee's attitude and also the convergence. Employee's attitude we refer, some employees, most of the members of the organization for that matter, they are not willing cooperate with the performance measurement. They don't want the performance to be measured for their investment center different from the corporation. So the employee's attitude is another important aspect. Similarly, the convergence, to what extent this investment center fits in the overall organization and overall it makes use of the existing organizational resources and the capacities in building the organizational investment entity. Unless you solve these problems, the performance evaluation of investment center will be incomplete without taking the accounting constants, the accounting policies and the accounting standards, accounting methods used in investment center should be the same as throughout the corporate entity. They should not be different from one accounting entity to the other accounting entity, because you are going to measure and compare the performance of investment centers throughout the corporation. So these accounting policies, accounting methods and principles should be uniform and consistently followed throughout the organization. Then only the performance evaluation of the investment center will be over. With this, we can say that performance evaluation of investment center will go a long way by solving all our performance improvement endeavors.
మా కార్యక్రమాలపై మీ సూచనలు సలహాలు ఆహ్వానిస్తున్నాం. మీ సూచనలు సలహాలు మాకు తెలియజేయవలసిన చిరునామా: డైరెక్టర్, ఆడియో విజువల్ ప్రొడక్షన్ అండ్ రీసెర్చ్ సెంటర్, డాక్టర్ బిఆర్ అంబేద్కర్ ఓపెన్ యూనివర్సిటీ, ప్రొఫెసర్ జి రామరెడ్డి మార్గ్, రోడ్ నంబర్ 46, జూబ్లీ హిల్స్, హైదరాబాద్ 500033.